Have here is an uptrend. We're putting in higher highs and higher lows. Now let's imagine that this red arrow is the daily chart, and that's clearly putting in a higher high, a higher low, a higher high, a higher low, a higher high. Now if we're looking at, say, the 1 hour chart, which we'll use as these white structure lines, what we can see is as price is creating this overall daily impulsive leg, we're putting in a series of higher highs and higher lows. Now once the daily chart begins to pull back to form the higher low, what we'll begin to see is market structure changing on the hourly chart. We're going to start seeing a series of lower lows and lower highs. This is important to understand because when we see this on the hourly chart, we can begin to think that price is reversing, that a bear trend is beginning to start, and that price will just continue moving to the downside. Now, if we use the higher time frame sentiment and understanding that price on the daily chart is putting in those higher highs and higher lows, we can begin to understand that when we're seeing this sort of behavior, that when we break structure to the downside on the hourly chart and start putting in lower lows and lower highs, that while we can look for sell opportunities to make trades here, we should be keeping the overall higher time frame picture in mind, and that at some point we are going to put in the higher low if the bull trend is going to continue. So from a management perspective, the trade should be a little bit more aggressive in that regard. And then basically what we will then see is a break of market structure. Then we will start seeing the hourly chart putting in a series of higher highs and higher lows that then will form the daily overall bullish impulsive move that is then creating structure and continuing to trend in a bullish or upwards direction. One of the most interesting things about market structure and trading in general is that there are multiple ways to do the same things, and it ultimately comes down to your own personal preference and what you feel works best for you. Now, when we're looking at market structure, there are essentially 3 different types of ways to map out market structure and identify the breaks of market structure. Now, let's go through the 3 different types. The first type we're going to look at is a market structure mapping using the candle bodies and a market structure break identification using the candle bodies. Now, if we look at this example, we can see that price has traded up and then traded back down in. We've denoted the high on the close of the bullish candle and the open of the bearish candle as they are identical. We can see that price then moves back in, spikes the highs, trades back down below, and continues downwards. It didn't actually close above this high, so we can say that this high is still the most previous high in this overall move. Now we can see that price then impulsively starts to move to the upside and breaks and closes above this high, and we can denote that as the overall break of structure. Now, if we're looking at this from a standpoint of what do these wicks actually represent, it can be seen that this is more of a play on the liquidity of the prior high. We can see that price spiked above this high, so anyone that would have sold here would likely have their stop losses above this candle. It took that liquidity, which then moved price down lower. It took the liquidity of this low and then continued to the upside. And our break of structure would be denoted right here once this candle breaks and closes above this high. Now, if we look at the second example, we're going to be identifying and mapping out structure using candle wicks, and we'll be identifying the market structure breaks with candle bodies. So similar to example 1, we can see we have this up move and we have this high candle, which is a swing high because this high is lower than this high and this high is lower than this high. We can see then that price moves to the downside and continues moving to the upside. We spike that high, but we don't actually close above the high, and then we trade back down.